all on the Harris and Trump economic and tax proposals. We're going to go heavy into the tax proposals, but we're going to start with the economic proposals. This is just for those of you who don't know, we actually do twice a month. We do a webinar called Wealthability Live, and we equally always start with poll questions because we want to see where people are. And then we always then go into an explanation of, the topic we're going through, just like I'm going to go through now. And then we go into open-ended questions. So that is our Wealthability Live. We'll talk a little bit more about that later. Very excited to talk about this. I've been voting since 1976. And I don't recall an election where the economic proposals and the whole goal of the two candidates from an economic standpoint have been as different as they are here, with a few exceptions, obviously, that have become pretty clear over the last few weeks anyway, where there become some similarities in certain things. But overall, what happens generally with a candidate for president is they tend to focus on a particular area of the economy or a particular group involved in the economy. And that is absolutely true with these two candidates, Harris and Trump. Now, for example, Ronald Reagan, that I remember quite well. I was actually in Washington, D.C. during his term in office. And he was very focused on investment and investors, as was John F. Kennedy, was also very focused on investment in the economy. Joe Biden, contrarily, has been very focused on workers. Many of his proposals have focused on workers and wages of workers. So here we have a similar demarcation between the two candidates. I'm going to walk through, and I think for context, I find in this case using Robert Kiyosaki's, my friend Robert Kiyosaki's cash flow quadrant is a really nice way to illustrate the different candidates. And again, I'm not going to say which is better, because it's better in the eye of the beholder. My job here today, besides answering your questions, is to explain what the proposals actually are and give a little bit of analysis on the proposals. So I'm going to share my screen right off the bat. Those of you who have been in Wealthability Live know that this is, I pretty much can't talk without a pen in my hand or a marker in my hand. And for those of you who aren't familiar with Robert's cash flow quadrant, basically what he illustrates, and that's his second book after Rich Dad Poor Dad, is that there's four ways that people primarily earn their money. They either earn it as an employee, the E quadrant, a small business or sole proprietor, S quadrant, a big business, the B quadrant, over 500 employees, or a professional investor, the I quadrant. And over the years, typically what we found in the US and other countries is that tax rates follow closely the same pattern. And that pattern is that a highly paid employee typically pays around 40% in tax. A small business owner pays up to 60% in tax. A big business owner pays closer to 20% in tax, and professional investors pay 0%. So that's how, for example, Trump said his tax returns actually showed he didn't pay any tax. That's primarily because this is where he resides, and we saw President Biden's tax returns, and this is where he resides, so he was paying closer to a 40% tax rate. That's not uncommon. So what we want to look at today is, all right, so how do these proposals match up on either side of this? Now, one way that I look at these different quadrants is typically I look at this side as the consumer side. And the reason is that that is how they primarily function in the economy, is consumption. It's not that they don't produce, don't do other things. It's that is their primary function. That's basically their primary effect on the economy, is consumption. Over here, this is production, or the producers. And again, I'm not suggesting that the employees and the small business owners don't produce. They simply don't produce. They consume. Their impact on the economy is greater as a consumer than a producer, whereas on the B and the I quadrants, their impact on the economy is greater as producers rather than consumers. Okay. So let's start with the economic aspects. This is the non-tax plans. But here's the economic proposals of the two candidates and where they reside. And I'm going to use traditional Democrat and Republican colors. So blue for the Democrats and red for the Republicans. And I'm going to start with Vice President Harris and walk through some of her her economic proposals, which you'll see there's quite a bit of detail in these economic proposals. I'm going to start with rent controls. It's interesting the way she's doing this, but this is effectively what she wants to do, is rent controls, grocery price controls. So these are all to help the consumer, ostensibly. That's why I'm putting them over here. Drug price controls. So several price controls. Then we have union pay requirements. Now, this is not requiring people to be part of a union, to be clear. But what she's adopted most of President Biden's economic policies, and one of their policies is to require union pay amounts for certain benefits. So definitely this is a plus for the employee, right? This is an employee. Increase minimum wage. And eliminating the right to work laws. For those of you who don't know what a right to work law is, it means that you can quit at any time. You can be fired at any time. Several states have right to work, meaning that it's basically a free market for employees. And other states, notably California, have other laws that it makes it much more difficult to fire an employee, and kind of restricts what you can do as an employee. A couple of interesting ones also is restricting bulk home purchases. This is an attempt, and it's a really interesting proposal, to prevent companies like Blackstone from buying up whole neighborhoods or hundreds or thousands of properties for rental and controlling the rental market of homes. So that's one. And then expanded ACA payments. This is the Affordable Care Act. And again, these are all non-tax proposals. And that's why I have them here. Now, interestingly, on the Republican side, Trump doesn't have a whole lot of stated economic policies other than first one would be deregulation, which definitely helps the right side of the quadrant, the B's and the I's, deregulation, and tariffs, which there's argument on both sides of whether that helps or hurts. I'm going to put it over here for now, that it's, it's protectionist to protect the U.S. producers. There's questions that I'm not qualified to answer about whether they actually do that or whether they actually limit what domestic producers can do, because so many of their parts are purchased from overseas. So a lot of that's going to be, the devil's going to be the detail. One thing that he has put that he did in his first term that we would expect in the second term would be oil production, and particularly pipelines. He was a big proponent of the Keystone Pipeline, which Biden killed, and then leases on federal lands. So that's about it that I can see in his economic proposals that are non-tax related. He has more tax related proposals, which we're going to get to in a minute. But these are the non-tax related. And so if you have questions about these, please put them into I'm going to go through all of this, and then we'll go through and we'll take this up. But if you have questions, please put your questions into the Q&A, okay? Or make a note of it and raise your hand when the time comes. We're going to do our questions and answers after I've gone through the basics here. And then we'll discuss them as we go here, all right? So I'm going to take my own picture of this so that I can bring it back up. And next we're going to go to the positive impacts. And I'm not talking about positive in that for or against. I'm talking about what tax benefits are being recommended by either of the candidates. And I'm going to go back to the same diagram and do this the same way. And we're going to walk through cash flow quadrant. We're going to go to, just remind you, E, S, B, and I, right? And just as a reminder, primarily consumer benefits. And this is so interesting. You saw all the consumer benefits of Harris's plan. Biden was a very worker benefit. That was his, he said, I'm a union guy. And I don't remember when we've had somebody focus so much on consumers as Vice President Harris, as a candidate focused on the consumption side, as opposed to like the worker side. Okay, so increasing jobs or increasing employment, things like that. That's really not hers. Is very, very direct on the consumer themselves. And let's show you some of those from a tax standpoint. So from a tax standpoint, she wants to bring back the full child tax credit of $3,600. Now you could say this is a worker proposal, by the way. That's the idea. There is a child care credit and a child tax credit. They're two different. So child tax credit is primarily consumer, you think of, and then the child care credit would be worker, right? That's a benefit to workers. So that's in there too. So we'll add that one in there. Child care credit. That's for, that is solely for childcare while you're working. Okay. Then we have the baby tax credit, which this is a new proposal. And this is similar to what they've done in a couple of other countries. This is $6,000. Um, um, this is in the 2K plus. So, and I don't remember exactly the number of the child care credit. The baby tax credit, $6,000. That's for when a child is born until they're a year old. That is, Australia has had similar promotions of people having babies. Okay, or maybe taking some of the financial burden off of having a baby. Another one is first-time home buyer credit. This was done previously by George W. Bush. Not to this extent, but we didn't have housing prices. And this is $25,000. Then we have no tax on tips. Also one of Donald Trump's, we'll get to that. Small business. So this is an interesting one. This is a small business startup deduction. Currently, it's at $5,000. She would increase it to $50,000. So that means that the costs of starting a business normally are capitalized, meaning you have to deduct them over a period of years, 15 years. But if it's over $5,000, under Harris, she would allow you to deduct up to $50,000 for a startup. Then also an increase in the earned income tax credit. This could be a worker, could be thought of as a worker. Typically, it's only applied to workers. During COVID, they actually applied it to some non-workers. So have to see. And then interesting, a small business standard deduction. Like a personal exemption. How that would work, nobody really knows. Whether it would be a percentage of your income. My guess it'd be similar, a simplified thing to do, like the simplified version of the home office deduction, right? So not as much as if you did the actual, but a simplified way to do it. Now, on the producer side, Harris has proposed a home builder credit for low-income housing. So it's a home builder tax credit. She hasn't been specific as to how much, but a home builder tax credit. Expand, and I am going to comment on this one because I like this one a lot. The low income housing tax credit, which has proven to be a big boon to low income housing. And then a neighborhood, this is a new one, new proposal, a neighborhood low income housing tax credit that would apply to actually the homeowner. So it would be for a homeowner actually refurbishing a home in a low income neighborhood. Okay, that is Harris. On the Trump side, we have reduced the manufacturing corporate rate. Oh, by the way, these are all I'm going to say this is the plus side of the equation. So what I'm doing now is I'm giving you all the tax proposals for these two candidates that would help, that would provide benefits to certain groups. We're going to get into next the tax side that actually penalizes or hurts a particular group. All right, so he would reduce the capital gains. You reduce the corporate rate, not the capital gains rate, the corporate rate to 15%. He suggested one time he suggested it was for everybody, and one time he suggested it was just for domestic manufacturers. Next, he would allow for 100% bonus depreciation. All you real estate investors be happy with that one. He would allow for full expensing of research and development, cost expensing at 100%. He would continue the 20% qualified business income deduction. And just a comment here. The reason I've got this on his, but not on Harris's. Harris would continue that if you're under 400,000. Okay. So that would actually be, we could actually put that over here under Harris is a small business. We'll just call it that, small business. Qualified business income deduction. Okay. So we'll put that there on hers. But he would, and then this is one where many of you probably are not familiar with this plan, but this is the, this is how foreign income taxation of international companies based in the US are taxed. It's the guilty fiddy regime, which I've seen with my clients has definitely benefited them. So he would extend that. On the consumer side, Trump has proposed exempt overtime pay. Exempting overtime pay. Now that, again, that would be a worker rather than a pure consumer benefit. No tax on tips. He proposed it, and Harris basically agreed with it. Anytime you have two candidates agreeing on something, you think there's a particular chance of getting that. Exempt Social Security from tax. This one I read just this morning that 83% of voters are in favor of this one, exempting Social Security from tax. It's a big number. So that's an interesting one. He recently announced a deduction for car interest. And by the way, I'm only bringing up the big ones. I mean, Harris has a, I think it's an 85 page. Hang on, I'll tell you. It's 82 page plan, economic plan. So there's a lot of things that I'm not able to include here, but deducting car interest and eliminating, this is one I am particularly in favor of, the worldwide tax on citizens. We are the only country that does this. Every other country, you're taxed wherever you're a resident. So if you're a citizen of France, but you're a resident of Germany, you're taxed in Germany, but not France. In the US, we do have a foreign tax credit. Okay, so that's supposed to offset it, but you could have lived in Germany your whole life, basically, or London your whole life, but you're a citizen because you were born in the US, and you're a citizen of the US, and therefore you're taxed on, you're taxed both in Great Britain and you're taxed in the US, only there are certain, there's a foreign tax credit to offset. So it's not as big a benefit as it seems, but it is actually would put us on par with the rest of the world. I kind of like that one. He also has gone back and forth on the SALT deduction, which is the state and local income tax deduction. It's a huge number. It's about $1 trillion over 10 years to bring it back. And frankly, That's one I struggle with because it's a tough one from an economic perspective, but we'll put it in here. Harris presumably would do it too, though, so we'll leave it off. That's what we'll do. Okay, next. Okay, so here's the pluses. Okay, now let's talk about time. Sure, get that. Now let's talk about the minus side. Okay, what are some things that the two candidates are doing that might hurt one side or the other? Okay, so once again, we have ESBI. I'm going to put up here consumer. You could also put worker up here, consumer, and over here producer. And let's look at some of the things that they're doing to hurt, that will hurt. So this is minus. On Harris's side, she would tax unrealized gains, which would, the reason I'm putting that over here, I'm going to put it both places actually. But the proposal is it's only on people with $100 million or more of net worth. So why am I putting that on the consumer side as a negative? And the reason is because if it particularly requires, if you have investments in the stock market, if your primary investments are stock, okay, so these are Wall Street people, you would actually have to sell your stock in order to pay this tax, 25% minimum tax on unrealized gains. So that presumably would bring the stock market down. Okay, so that would tend to hurt 401ks, IRAs, anybody else with investment in the stock market. So I'm going to put that there. On the investment side, she would make the loss limitations. I'm going to talk about this real quick, and I'll go through some of these in a little more detail. Basically on investing. What this is, this was actually first in the 2017 Act that Trump proposed. So Trump did actually limit this. His limit was a 1-year limit. Basically, here's what happens. So you're allowed to offset you can take your business losses, which include from real estate, oil and gas, any hard assets. You can offset those losses against any business income, unlimited. If you have losses in excess of your business income, and by the way, wages do not include business income, wages are not included in business income, then you're limited to, at the time it's 500,000. It's gone up by inflation adjustments quite a bit since then. But say it's limited to 500,000, then it carries over to the next year, and it's allowable as a net operating loss in the next year. What Harris has proposed is to not allow it as a net operating loss, but it would continue to carry over. So it would be an increase. Let's say we're going to increase the loss limitation on investments. Harris would continue the IRS audits. And the IRS audits she has proposed, are only on this side. Okay, now, and you think about it, you go, well, wait a minute, anybody over 400,000, but employees don't get audited. There's nothing to be audited. So a high earning employee is less likely to be audited, but a high earning business owner investor, much more likely to be audited. So that's why I put that over here. She wants to put on merger restrictions. Particularly in the grocery business, where she feels like mergers have hurt competitiveness in the grocery business. She wants to raise the corporate tax rate. to 28%. Now, technically, you could probably put that on the consumer side as well, because again, that will obviously hurt the stock market. So she wants to increase the capital gains rate to 33%, the top capital gains rate to 33%. Now, that would apply on joint filing $1 million, single as 500,000, anything over that. Now, why is it 33%? You're asking because, wait a minute, it's 28%. No, it's 33% because she wants to raise the net investment income tax from 3.8%, which applies to employees, implies across the board, but she wants to raise it from 3.8% to 5%. So the capital gains rate would be, in fact, 5% plus 28% or 33%. That would definitely hurt the investor side of the equation. She wants to eliminate 1031 exchanges, the like kind exchanges, over 500,000. She wants to, this is an interesting one, tax gifts and inheritance. As capital gains. Again, there are limits. You can pretty much put in here 400 to 500,000. If you're under that, you're not going to be hit by this. Okay. Again, that's a consumer benefit, right? But it's a benefit of not getting a tax increase. It's not a decrease. So it's real only basically a minus to this group. It's not a plus to the other group. Boy, be nice if I could actually write this, huh? So this is gifts and inheritance. She'd actually tax that at capital gains rates if you're over those limits. She would similarly decrease the estate tax exclusion. You say, well, why is that here? Because this is who it primarily harms. She would decrease it by 50%, down 50%, from roughly 14 million per person to 7 million. She would tax unrealized gains. I'm going to again put that over here. Tax unrealized gains. Now, again, this is only on under her proposal for those who earn more than 100, that have more than $100 million of net worth. She would add a net investment income tax, again, over a certain income limit on pass-through entities like S-corps. This has not been here before. This is actually a major increase to the business owner. Now, the question is how you quantify a small business. But small businesses, if they're small, then they're not going to get hit by that tax because that only applies if you're over that $400,000 or $500,000 limit. And then on the Trump side, you have to put tariffs over here. Tariffs are a really interesting one because while there's, according to Donald Trump, the intention there is to get manufacturers to move to the U.S. Okay, that was the intention of lowering the corporate tax rate. And it's worked. Okay, that's actually worked, lowering the corporate tax rate. But remember, that's across the board, lower tax rate. That applies to U.S. People who reside in the U.S. and people who just sell in the U.S. because they pay U.S. tax as well. Tariffs would only apply to people selling into the U.S. But it does definitely, if you look at history, tariffs tend to increase prices to consumers. So we're going to put that as a negative to the consumers. And then he wants to eliminate the renewable energy tax benefits of the 2022 Act. So he would basically eliminate a lot of those tax benefits. So those are the kind of three groups that I wanted to show you. And I'm going to stop sharing here. And perfect timing here. We got a whole bunch of questions here. If you want to ask it live, then please do so. And we'll examine these in more depth as you ask your questions. And if there's any one particular area that you want me to go into in more detail, I'm happy to do that. Or if you just have questions about how's this going to apply to you, or how will this apply, or which ones are more likely to happen, we can talk about that. I'll get out my crystal ball. We'll see what we can do there. So Jamie, let's go ahead and take our questions here.
Perfect. We've got a first hand raised from Rudy.
Rudy? Rudy. Hey, Rudy.
How are you?
Good. How are you?
Good. I actually did not have a question, but I don't know how that hand got raised. Sorry about that.
That's okay. It could just be your motion. Thanks, Rudy. Thanks for joining us.
All right. We have a hand raised from Mary.
Mary. Go ahead and unmute yourself. Okay, Mary, we can't hear you. All right, let's go on.
All right. Joe.
Joe, go ahead.
Can you hear me?
Yes, we can, Joe.
Okay, good. Third time's a charm. So I wanted to see if you could expand on the 50,000 for the startup thing, because I guess I don't understand. Is that only basically whether they raise it for 50,000 now and it was 5,000 before? Is it basically only pertaining to, like, if you start a business and you make expenses that were for the business, but before you officially filed, like, let's say you start your business officially on paper with an LLC, you file with the state, like a year after you actually kind of started getting things going. Is that really what it's pertaining to? Or,
right. So,
I thought you could.
Oh, sorry. Go ahead, Joe.
I just don't understand. I thought, yeah, I just was curious on clarification on, because I thought you could, write off expenses if you, I thought, I guess, I don't know. I was confused on it.
Okay. Well, let me explain that. So, to get a business deduction, it has to be in the ordinary course of your trade or business. So you have to have started your business. Let's take an example. If you're, you have to be open for customers. Let's put it that way. If you're, let's say you buy a rental property, that rental property is, and let's say that's your very first rental property. You are in the startup phase until that rental property is ready to be held for rent, right? Until you actually put it on the market. So you've got to be in the business in order to get a business deduction. Startup expenses are everything that you do before you actually open the doors. So for example, if you're opening a restaurant, all of that work you do before you open the restaurant, all those expenses on advertising, all those expenses on marketing, on refurbishing your property, all of that stuff, that's startup. That's not deductible. Now the capital expenditures, like on equipment, those will start to be depreciated once you place them in service. So they're not subject to the startup expense limitation, but any other costs that would otherwise be deductible if they were when you were in business are not deductible. The exception to that is if you only have $5,000 of expenses, right, then up to $5,000, then you can deduct them currently. Otherwise, you have to amortize those over 15 years. That means you're taking 1/180th per month, okay, or or 1/15 per year of your deduction. That's called amortization. Now, under Harris's proposal, the for up to $50,000. So it's just her proposal is simply to change it from 5,000 to 50,000. It's that simple. All right, is Mary back?
Mary is not back, but we have Heather.
Heather. Hi, Heather.
Hey. Hi, Tom. It's so nice to meet you. I love your work. I just want to huge say thank you for that. It's
Thank
changed
you.
my perspective. I've definitely been studying Kiyosaki for many years, but I just want to say one of your latest books, I just read, The Tax-Free Wealth, about how the government, like it's almost like from that perspective of how the government says, okay, you're either going to work for us and be our slave, or you're going to produce what we want to produce and we'll help you, right? And it really just shifted my entire perspective. So I just want to say thank you before I ask my
Awesome.
question.
Thank you. So
You're
what's
welcome.
your question, Heather?
So my question is specifically about, I'm not going to vote for Kamala, but I was curious on her perspective of why she's saying $50,000 on new businesses for someone like myself, who my business is already in existence. How would that help growth? Or am I not seeing that correctly? I just kind of wanted to ask. And then my second part of that question is, what is Trump saying to kind of counteract that? And what's his declared policy on that?
So Trump hasn't said anything on it. You'll know, you probably noticed that Trump actually has a lot fewer suggestions on changes to be made than Harris does. And now Harris, by the way, all of the Tax Cuts and Jobs Act, Harris wants to continue for people making under $400,000. Okay, to be clear, she does want to continue those. So she likes what he did. She just doesn't like him for anybody making more than $400,000. On the $50,000, that's just for a startup business. So if you're already in business, you already get to deduct everything. So you don't have any limitations on deducting your expenses, your business expenses. It just has to be ordinary and necessary and documented. And as long as that's the case and you've got a business purpose for it, you can deduct it. The limitations are on those who are just starting. So the idea behind it is per Harris, is to encourage startup businesses. Now, I've long thought that $5,000 was too low. And actually in my book, The Win-Win Wealth Strategy, I actually go through an example of starting a business and how there's so many deductions available that starting a business, the government will actually pay you to start a business. And if you increased it to 50,000, now I would probably increase it less than that. And I'll tell you why, because there's in a lot of these cases, there's room for manipulation. Overtime pay, tips, those exemptions, huge room for manipulation. So not sure how those would be implemented. Same with this one, huge room for manipulation, because presumably if you're under 400,000, you're not going to get tax audits. So the IRS isn't going to question. So why wouldn't everybody say they started a business and the first $50,000 is of their expenses and just take that as a deduction? But the idea behind it, okay, forget all the manipulation, all that kind of stuff. The idea behind it clearly is to allow for a bigger tax benefit so that you have more incentive to start a new business. That's really the reason behind it. Who's next, Jamie?
We have Adrian.
Mr. Wheelwright,
Adrian,
what a pleasure
how are you?
speaking with you. What a
Thank
pleasure
you.
speaking with you. Thank you so much for bringing back hope. I have a question about two questions actually. First of one is, what is the candidate's plan to reduce the interest rates, and how are they combat that?
So that's an interesting one. So that is actually, so interest rates are the purview of the Federal Reserve as a general idea. Now, the Federal Reserve has two stated goals. Their goal is to keep inflation down and to and then they also keep employment up. Those are the two things that they're supposed to do. Their mandate, as they see it, is to reduce unemployment, keep relatively full employment. They have a target there of 3 to 4% unemployment, and they have a target rate of inflation at 2%, as most of you know. So the question is, what will the candidates' proposals do to interest rates? When do interest rates come down when the economy, interest rates go up. Sorry, interest rates come down when the economy slows. Interest rates go up when inflation goes up. So the Federal Reserve uses interest rates, and this typically, they kind of follow. The Federal Reserve isn't actually the cause of this. They're actually, they just follow along with what's actually going on in the economy. But that's for I had a whole podcast on that. Check out that podcast. So let's look at what happened recently, right? We had big inflation, somewhat as a result of the COVID and somewhat as a result of government policies. But typically, inflation is too much money chasing too few goods. So if, for example, tariffs create too few goods, then you would have inflation. Now, a tax, and a tariff is a tax. Okay, so a tariff's a tax, and you can either look at it as a tax on the consumer, like a sales tax, or you can think of it as a tax on the producer, because it might reduce the amount of, what they can charge. In other words, it reduces their profit level. So, but it's a tax, so it's not technically inflation. While it might increase prices, it's not technically inflation. So the Federal Reserve presumably would not do anything to combat tariffs. So to the extent tariffs increase prices by themselves. Now, if tariffs cause inflation, which I would have you go to someplace like the Tax Foundation to get that kind of analysis. And they're great, by the way. They hate tariffs, just by the way. They do not like tariffs. But if you go to the Tax Foundation, anyway, you can get that kind of analysis. Tariffs, though, aren't technically by themselves inflationary. What's inflationary is too much money chasing too few goods. I had a conversation on a podcast with an investment banker not too long ago, and I would have you check out my podcast, The Wealthability Show. And on that podcast, I asked the investment banker, because I've not heard this discussed, whether the the high taxes on the producers, or what I call the investment class. So people making, especially more than $1 million, I call that's the investment class. I mean, those people, you can't spend $1 million during the year. So they're not affected by inflation. Okay. They don't reduce their consumption based on inflation. Okay. They tend to continue to consume the way they would consume otherwise. That's why you see luxury goods not really affected in a downturn, right? Because those people that consume there are going to consume. But what happens is you're basically taking money out of so what do they do with their money? They invest it. So they invest in real estate, energy, agriculture, business, stock market, right? That's what they do with, because it's extra money. So what are you going to do with it? You're going to invest it. Well, basically what Harris, her proposals do is they actually take money out of investment, which doesn't have an impact on consumer goods inflation. It has an effect on price inflation, right? Certainly we've seen price inflation in the stock market. We've seen price inflation in the housing market. But it does impact, on the other side, she's got a lot of money going to consumers, which does mean money's being put into the market. So she's putting about $8 trillion into the market. Okay, that's coming out primarily, not all of it, some of it's deficit, but it's primarily coming out of the investment. So it's actually new money into the economy. So it would function very much like the COVID increases, the American Rescue Plan that Biden did, $2 trillion in 2021, and the Trump plan in December of 2020, both had inflationary aspects to them, because you were putting more money into the economy in an economy that's already doing okay, relatively speaking. That would be the same case here. Okay, so you would definitely have an inflationary pattern. On the other hand, you could actually slow down the economy, which would be deflationary with tariffs. It could actually slow down the economy. So you could actually be deflationary, which obviously the Federal Reserve is quite opposed to that. They're quite opposed to deflation. They think that that is the worst case scenario, is heavy deflation. But it certainly would slow down. You would think tariffs would have a tendency to slow down the economy in the short run, right? So the investment would presumably, the increase in investments like the 100% depreciation deduction, which is, by the way, we're one of the few countries that doesn't do that on everything. Most countries do 100% deduction for equipment, at least. And the deduction for research development, the decrease in the corporate tax rate, those are all positives for investment. Okay, they don't really spark inflation. So inflation and interest rates tend to go together. That's why I'm talking about inflation, because if you have something that's inflationary, then the Federal Reserve feels like they need to increase the interest rates. If you have something that's deflationary, the Federal Reserve tends to decrease interest rates in order to stimulate the economy. So that's where you have to look at what is going to be inflationary in these policies and what is going to be deflationary in these policies. Really good question. By the way, so just so you know, those of you who are not part of our Wealthability Live group, we're going to actually talk about it. We've actually never offered it outside of our clients before. But we are going to offer it for the first time. In fact, I'm going to have Jamie go ahead and put that link in there. We've got a special offer for you, which I'll talk about later in the program here. But this is what we do. So Joe, as an example, Joe's one of our regular participants in Wealthability Live, and asks really good questions like you did there. And we do that twice a month. Every month during the year. So we do it basically just like this. We start out with the, we start out with I start with some education on a particular topic, in this case, right? It's Harris Trump. And then we go into question and answer very much like this format. So I want to give you an idea. This is what Wealthability Live is like twice a month. And we have a really lively discussion during that as well. Who's next, Jamie?
Carlos typed in a question. He says, what types of deregulation and for what industries?
That we had more specifics on that. Trump likes deregulation everywhere except immigration. That's where he likes regulation. But he likes deregulation across the board, is where he would like to have fewer regulations written. In fact, during his first term, he actually ordered that a number of regulations had to come down in order for a new one to be written. And so his goal, of course, as you know, is to reduce the administrative complexity of whether it's construction, manufacturing, no matter what your industry is, that is the stated goal from a deregulation standpoint.
So we have a live question from JP.
JP.
Hey, Tom, can you hear me?
I can. How are you doing?
I'm doing great. How are you?
Good, thank you.
Hey, real quick, on the LLC Transparency Act that's going to be coming here. So, if you did any LLCs before 23, you have to get them all registered here this year. What are you seeing with your clients? Are most people getting these done? Will there be any big changes that we don't have to do them, or what are you seeing there?
Interesting. So, and interesting that neither candidate has talked about this, by the way. So let me explain what he's talking about. This is the Corporate Transparency Act, and it's called corporate, but it also applies to limited liability companies. And basically what it says is you have to identify to the government, and presumably, and it's supposed to be only law enforcement that gets this information, but you have to identify all of the owners and beneficiaries. So that includes through a trust. So trusts, one of the great benefits of trusts historically has been that if you own something in a trust, nobody knows who you are, because a trust is private. It's not, it's not produced anywhere except probably to the bank, right? But nobody else knows, has seen the trust document. Unlike like the articles of organization, not the articles of organization, but maybe you look at the, if you form an LLC in most states, you have to say who the owner is. If you form, not all states, but most states. If you form a corporation, you have to say who the owners are. So there's a lot of disclosures, but not for trusts. And so this is all beneficial owners or people who have a lot of control. You have to actually disclose them. You have to get all sorts of information. And that's the Corporate Transparency Act. There have been lawsuits to overturn it. So far, one lawsuit has been decided in favor of not overturning the Corporate Transparency Act. I've not heard either candidate talk about eliminating the Corporate Transparency Act, although there are some calls in Congress for eliminating the Corporate Transparency Act. This was bipartisan, by the way. The Corporate Transparency Act actually was enacted during Trump's term. So we can't really call this a Democrat or Republican policy. It is something that was enacted. It's a little, to me, it's a little like the Patriot Act. Not a big fan. My clients are all doing it. I mean, we actually have a paralegal on staff that is doing this for our clients. So I'm seeing most people are doing their best to comply because the penalties are significant if you don't comply. All right, who's next, Jamie?
We have an anonymous question. Why was the last Trump plan on the Harris side? And I think this is in reference to the first slide comparison you did.
The last Trump plan. Yeah, I'm not following that question.
Okay.
You do understand though that Harris wants to continue the Trump tax reform of 2017. She wants to continue that for anybody making less than, for the most part, anybody making less than $400,000. So that would be on, she would propose that. Trump wants, of course, to continue it and make it all permanent, no matter who you are, no matter what side you're on. And so that's the big difference on the Trump tax plan, on the 2017 Act.
Thank you. Next question is from Robert. Do you have a sense of how much of the VP Harris plan would actually pass Congress?
Yes, I do actually. So I expected somebody would ask that question. So let's look at this. So let's look at some of the big tax ones. Again, of course, it completely depends. Remember, this is Congress, right? The president can propose it. They can put it in their budget, but Congress doesn't have to pass it. Let me give you a good example of that. During President Obama's years in office, every year in his budget, he proposed eliminating the tax benefits of oil and gas production. Every year, never was passed. Biden has done the same, never has passed. So they don't always get passed. Now, in Biden's term, which is also Harris's term, there was a plan called the Build Back Better plan, which was a massive tax increase. And that was actually defeated by two senators, Senator Manchin and Senator Sinema, both of whom are not running this time. So a lot of this depends on who controls Congress, who controls the House and the Senate. So it depends. If it's a Democratic sweep, we'd get one answer. If it's a Republican sweep, we'd get a different answer. It's more likely, of course, always that you don't get a sweep. But we weren't supposed to get a sweep in 2020, but we did. So Georgia went contrary to how most people thought it would go at the Senate. And so we ended up with a Democratic-controlled Senate. And that's why we got the Inflation Reduction Act, which was really a scaled-back version of the Build Back Better plan. So remember, whoever wins is not going to win by a lot. So, you know, you only need one or two defectors like Manchin and Sinema to cause it to fail. Remember, though, that when it comes to the budget, we don't have a 60% vote requirement in the Senate. We only have a 50% plus vice president vote requirement. So let's say, let's take worst case scenario if you don't like Harris's plan, whether you like her or not. But if you don't like Harris's plan, let's take worst case scenario to answer your question, which would be that the Democrats sweep. In that case, what would likely pass, what would likely not pass from a tax standpoint? I think you would see some of the positives pass. I think you'd see the child care credit because that has support on both sides. I think you would see the low-income housing tax credit. At least I hope you would see that on both sides. You might even see a trade-off there for the bonus depreciation and R&D expensing, because that was discussed quite a bit actually earlier this year and last year among both Democrats and Republicans. And there seemed to be some bipartisan support for that. Corporate tax rate, that's a tough one. It's actually a tough one because it's probably the most detrimental to the economy of the proposals, but it raises a lot of money. So that, I'd say, is a toss-up at best. The tax on unrealized gains, unlikely to happen. First of all, it's probably unconstitutional. But on top of that, there's a lot of rich Democrats, so they may not like it either. And it would have a severe impact. There's been a lot of discussion about the impact it would have on the stock market. It would definitely bring the stock market, have a negative impact on the stock market, which affects the average worker. So that one I would say is less likely to pass. The IRS audits, that would stay, obviously. The capital gains rate, that's a tough one. Who knows? Again, that's probably a toss-up. But capital gains and corporate tax rate, those are both big income raisers. So to get some of the benefits that they want to produce, to pass on to consumers, I could see that happening. Taxing gifts as capital gains, I do not see that happening. It's a terrible proposal. Sorry. I mean, I'm not saying Harris or Trump. I'm just saying that proposal, it's a terrible proposal, as is the tax on unrealized gains. Those are terrible proposals. Eliminating the qualified business income deduction, I could see that. There's actually, I would hope that there would be some entrepreneur representatives on the Democratic side, but who knows? That's probably a toss-up as well. Decreasing the estate tax exclusion absolutely would happen. I think that's the closest thing we have to a guarantee. There's not a lot of money in it, but the optics are so important to Harris and the Democrats that I think they would have to let that, and that's just an expiration. They don't have to do anything, right? Remember, some of these just are expiring from the 2017 law, and others they would actually have to do something. Corporate tax rate, by the way, that is the one thing that was made permanent. So they actually have to change that in the law. Whereas a lot of these others, qualified business income deduction, the estate tax exclusion, those would just expire. Those would just expire. The net investment income tax, that one's going to happen, I think, if the Democrats control that increase. And eliminating 1031s, I think that will not. I think it will not. I think it would have a major impact on the real estate industry. And I think it'd have too big an impact. There's another one, by the way, I forgot to put up, which is taxing carried interests as ordinary income. Carried interest is what a developer, that's how a developer earns their money. Okay. So they actually typically, they don't take any of the profits, or they take a small portion of the profits while it's being rented. But when it sells or is refinanced, they particularly when it sells, they get a big portion of the gain. That has historically been taxed at capital gains rates. Biden and Harris both proposed that it would be ordinary income rates. That would really, who that affects is developers. So both it affects Wall Street, private equity, and it affects all private equity, both Wall Street and real estate. Price controls. I don't know. That's an interesting one. I think it's a terrible idea personally. That just has never worked. Would that pass? I would hope not. The startup, I could see that, though maybe at a smaller amount than 50,000, maybe 10,000 or 20,000. I could see that one passing. Increasing the earned income tax credit, I could see that passing. The tax on tips, it's an interesting one. Yeah, both candidates proposing it. Not sure about it, but it could. That's maybe a toss-up, I would say. Other things like the first-time home credit, I could see that pass. Here's what happened. So the staff of the House Ways and Means and the staff of the Senate Finance Committee, they actually keep a list, and they're keeping this list right now. And things are on that list for revenue raisers. Things are on, see, we haven't talked a lot about revenue raisers outside of Harris's tax increases. Trump's not talked about any revenue raisers other than tariffs, but he will have to do some revenue raising. He will, just practically speaking, he'll have to do some revenue raising. So where will those come from? Well, those will come from the list that they keep. Okay. Everybody in Washington knows that there's a list, right? Now we have these things on the list. So from a Trump standpoint, let's look at the Trump side. Exempting Social Security. It's got a lot of people, like I said, 83% of people like it, but it's a big number and it directly affects Social Security. So you'd have to actually come up with new funding for Social Security. It actually, unlike the net investment income tax, which does not go to Medicare, even though they call it the Medicare tax, does not go to Medicare, it goes to general fund. The income tax on Social Security does go to the Social Security fund. Okay, that at least on the balance sheet. Exempting overtime pay, I would say no chance of passing that. Huge number and too easy to manipulate. Deducting car interest, you could do that. I'm not sure how many people that affects because of the standard deduction in the Trump Tax Act, but it depends on how they do it too. They could deduct car interests on page 1 instead of on Schedule A. So who knows? So I think there are some of these proposals that are more likely than others. I think on the Trump side, the most likely would be the I don't think he'll get all of. I suspect he may not get all of the 2017 Act if the Republicans control both the House and Senate, but I suspect he will get a lot. I think he'll get the 100% bonus depreciation. I think he'll get the research and development expensing. I think he'll get the qualified business income deduction. Those are the 3 big ones. And I think he'll get those. I doubt he would get the SALT deduction. I doubt that. It's too much money. And it frankly doesn't make a lot of sense. So I'm from a policy standpoint. So there you go. I went both sides. All right. Who's next?
Sean is next.
Sean,
Hey, Tom.
how you doing?
I'm doing awesome. It was great seeing you at AIM NatCon this year. Always love listening to you and getting your perspective on everything. My question is, what is your top favorite policy proposal from both sides and your bottom one?
All right, I'll go there. I don't mind. Let's start with Harris. My top favorite proposal from Harris would be the low-income housing tax credits. I think those have proven to be very successful. We need to do more of it. We definitely have a low-income housing issue. That's part of the problem with homelessness. So I'm a huge proponent of the low-income housing tax credits, and I kind of like her neighborhood low-income housing credit and the home builder tax credit. I kind of like those too. So I would lump those three together. On the downside, price controls, hands down. Price controls, just terrible idea. Because they tend to lead to actually increased prices. They take away competitiveness in the marketplace. You end up with black markets. There's just a lot of negatives and not a lot of positives. So that would be my negative on Trump. I would say number one that I like, and I like a couple of them. I do like the corporate tax rate down to 15% for manufacturing. I think that is very positive. And I very much like the bonus depreciation and R&D expensing. I think the qualified business income deduction has to follow if you're going to keep the corporate tax rates. It's just not fair to entrepreneurs if you don't. But I would say those kind of the full expensing and then the corporate tax rates, what I like. What I don't like on his is exempting overtime pay. I think it's a terrible idea. I will tell you, every one of my employees is going to want to be paid on an hourly basis if that comes into account, and that will be everybody. So now we're not paying based on production. We're paying based on time worked, and everybody's going to want to work overtime. Now, could you increase the amount of time worked? Yes. Will you increase productivity? Not sure, because if you have people, now you have all these exempt people, meaning that you don't have to pay them overtime. They're going to want overtime, which means that, you're right now, they're incentivized to be more efficient, right? Because if they're not efficient, they have to work overtime. They don't get paid for overtime. They're going to be incentivized to be less efficient. So that would be my least favorite. I would tell you also the no tax on tips would be the other one I don't particularly care for on his. Who's next?
We have Derek up next.
Derek.
Hey, Tom. Love your work. So
you.
this is more to your crystal ball comment. Both proposals do nothing for our overall deficit. And according to one nonpartisan group, Trump's plan is double the addition to the deficit that Harris's plan is. How much longer can we continue to kick the can down the road before we start focusing on our debt? Number one. And number two, if we continue to do this, where's the breaking point?
Yeah. So the answer to both number one and number two is nobody knows, because we've never had a global economy like this before. So, we've seen Japan. Japan has 200% of GDP deficits. They're still functioning. So we're not even close to that. We're at worst 120, 130% at worst. And, other calculations have us at 100% of GDP. Now, I'm an accountant, so I don't like deficits. I think they're a bad idea. I think you end up with interest rate challenges, and I think I think you have, because you're paying so much in interest, and your interest now becomes your biggest expense, and you're just printing money to pay your interest. And it's like, okay, at what point do you end up in hyperinflation? And that is really the question. Do you end up in hyperinflation? The argument for deficit spending is that you can stop the inflationary aspects of it any time just by taxing. But we've not seen any politicians that are willing to tax where the tax needs to happen. If you're going to increase spending in the consumer area, then who do you have to tax in order to keep the inflation down? You have to tax the consumer, not the investors, the consumers. And so that's why I say Harris's plan, in my mind, clearly would be would cause inflation. Clearly is inflationary. And so as you're taking from investment long term, and you're putting it into the economy short term, which is basically too much money chasing too few goods, because you're actually taking money out of the investment economy, so you actually have less production, okay, but you have more consumption. And less production, more consumption is just a recipe for disaster when it comes to inflation. So And inflation, by the way, but I will tell you, inflation is the way that politicians tend to deal with deficits. The tax that so they won't directly tax. So they don't like income tax. Ooh, bad income tax. But inflation is a much worse tax, and it is the most regressive tax we have. Regressive meaning that affects low-income people way disproportionately to high-income people. A wealthy person doesn't change their spending habits based on inflation. But a poor middle class, they're spending all their money. They're consuming 100% of what they get. So inflation is, and especially fixed income, inflation is and Warren Buffett, you want a good analysis of this. Warren Buffett's talked about it quite a bit. Inflation is the worst tax. It's the highest, most regressive tax, and it is the most likely outcome of the continued deficit spending on both parties. And you're absolutely right. Everything I've seen shows that Trump's policies would increase the deficit more than Harris's policies, because she is actually willing to tax some, but those analyses do tend to ignore the inflationary aspects and the inflation tax of the Harris policy. So on balance, I cannot say that one is better than the other or worse than the other. They're both, to me, equally bad when it comes to the deficit.
Thanks, Tom. Up next, we have Kathy.
Hey, Kathy. Hey, KW Kathy. You there?
You're self-muted, Kathy.
Sorry, Tom. I forgot my question.
No problem. If you remember it, we'll bring you back. Okay.
Awesome. Okay. From our Q&A, Tom asks, is the first-time home buyer credit phased out or limited for people with specific incomes?
Yeah, it would be. Presumably it would be. Now, I don't know. We don't get a lot of specifics from candidates, but presumably it would be. If you look at all of Harris's other proposals and Biden's proposals, and Harris is tagged on to most of Biden's proposals, then that is pretty clear that if you're a first-time home buyer and you're making $500,000 a year, you may not get that credit. I don't know.
Thank you. Our next question is from Andrew. He asks, for Harris's proposed unrealized gains tax, when would the gains be marked for taxation? At the end of the tax year or at the close of each trading day?
It's the end of the tax year. So basically the way the unrealized gains, it's an alternative minimum tax. So it'd be done on your personal income tax return. And I've done quite a bit of study on this because it's such an odd proposal. And because I think that if it were enacted, it would come down from 100 million to 10 million to 1 million, just like the income tax, as that's happened with the income tax. But what the proposal is, and you can read it in Biden's Green Book, by the way, Biden does a Green Book for his budget every year. And a lot of these proposals that Harris has basically adopted his proposals, plus added her own. So it's kind of Biden plus. The one where she's differed is on the capital gains rate, where he wanted it taxed as ordinary income rates, and she's got it at 28% plus the 5%. So it would happen so the question is, it would be the valuation at the end of the year, presumably. Okay. So, interesting to see what would happen to the stock market. You're just going to have a sell-off at the end of the year in order to pay that tax. If you're not interesting under the proposal, if you are not under the proposal, if you're not liquid, in other words, you're not in the stock market, then you don't have to pay the tax. You are presumed to have your wealth increase by the treasury rate plus 2%. You're presumed an increase. So you have a presumed increase, whether you increase or not. Now, whether they would allow you to actually value your property at the end of the year, I would presume they would, but that would be challenging, but that would be interesting. So if you had a 4% treasury rate plus 2%, that's 6%, meaning that you would pay tax on a 6% increase, whether or not you had a 6% increase, unless you proved that you had less than a 6% increase. That's basically how that would happen. If you were a non-liquid, if you're liquid, meaning non-liquid, meaning less than 20% of your assets are in the stock market. Okay. That's their definition. So it's a pretty interesting proposal. Hopefully does not get passed. I'm not a fan. Who's next?
David asks, Goldman Sachs is saying if Trump is elected along with the majority in both houses, that interest rates will rise due to more deficit spending. If so, will this hurt the already vulnerable real estate market?
I'm not sure. I haven't read that. I'm not sure why they're saying that. Typically, interest rates rise as a result of inflation. So I suspect they're saying that somehow that and it could be, if you exempt overtime pay, that's money into the consumer's hands. If you exempt tips from tax, that's money into the consumer's hands. You exempt Social Security, that's definitely money in consumers' hands, because those people, if you're getting Social Security, a lot of people are spending all that money. Deducting car interest, that's more money in the consumer's hands. So all of those would definitely put more money in the consumer's hands. And if those all came from deficit spending, the state and local tax deduction also put money in the consumer's hands. All of that would tend to be inflationary, as well as the tariffs. Could they be inflationary? They could, because if they restrict the amount of goods available. So in other words, if you have fewer goods available, remember, too much money chasing too few goods. Tariffs are more of an impact from an inflationary standpoint on too few goods than they are on too much money. You actually have less money. So the argument that tariffs are inflationary is you're going to have fewer goods in the marketplace. And because you have fewer goods in the marketplace, that's inflationary. And then you would drive up interest rates. Interest rates tend to go with inflation. So you tend with higher interest rates when you have inflation, because you're trying to battle the inflation. That's that impact. Who's next?
Tom, we have Martin with a live question.
Martin.
Hi, yeah. I just want to make a comment. I don't think people were looking at, because I haven't heard of many places. Trump's proposal, I think, could propose programs on two ends, could help reduce the deficit and maybe the debt. First being the proposal to bring in Elon to do efficiencies on the government. I think if you look at the jobs numbers in the last year or two under Biden, massive amounts of the job numbers have been government related, therefore driving up costs. And quite honestly, if you dealt with the government much, usually inefficiently. And secondly, the hundreds of millions we spend every year on illegal immigration support now, with the 20 million that went in there that have come in here. If the deportation actually takes place, that would be a massive relief both to the federal government, state, and local governments.
Yeah, so a couple of comments. So thank you for that, Martin. It's a good point. One of the people that I respect very highly is Art Laffer, who is, I call him the king of supply side economics. He was actually in the Reagan administration, and there's talk about him coming into the Trump administration should Trump win next month. And he is very much a proponent that lower taxes stimulate the economy enough to bring in more tax revenue, not less tax revenue. There is very good data to show that some of Trump's tax reductions in 2017, particularly the corporate tax reductions, did actually increase the amount of money that came into the U.S. economy and into the budget. Well over $1 trillion came back into the U.S. as a result of the 2017 Act. So there is some argument for that. Historically, I don't know that we've seen those numbers exactly, but that is the argument. And that is Trump's argument too. So he is absolutely making that argument. Certainly, a reduction of government costs would have a huge impact on the deficit. But remember, our deficit is largely social programs, is what causes is where a lot of that deficit spending comes in, and particularly entitlements. So a big portion is entitlements and a big portion is interest. So interest spending on entitlements like Medicare, Social Security. I'm in both programs, so right, I'm in that group. But that is where a lot of the money goes there. There's, I think, only about 20% that can be actually dealt with by Congress. If you take all the entitlements, interest, and all that kind of stuff out, it's not a lot. But certainly, I would have to agree that more efficient government would absolutely produce cost savings. So that's an interesting point. Thank you for that. You know what? Our time is up, but I'm happy to keep going for anybody who wants to stay on. I'm happy to go for another half an hour if you'd like. And I am going to, by the way, we will release the recording. Let me talk a little bit about Wealthability Live for those of you who have to go. Wealthability Live, again, it's twice a month for an hour, and it's typically in the evening. And we host that at Wealthability. Right now, I'm doing that. Sometimes I get help from other people when I'm not available. And we do it just like this format. So we go through a particular topic, either some tax or financial topic, and then we take questions. And we'll take very specific, like, how do I structure this deal, or how do I do this one, or how do I do that? It's not as broad as this conversation has been, generally speaking. We have not opened that up to the public before now. We're going to open that up right now to the public. That's the link that you see. So that offers out, right now, and you're welcome to take advantage of that if that's something you're interested in. All right, let's keep going here for a while, Jamie. I think we can go another half an hour. We'll go to the top of the hour.
Sounds good. Tamara asks, she says, "Hi, Tom, this has been really informative. Thank you. Can you talk a bit more about Harris's proposed corporate tax rate increases? This would still need to get through the House and Senate. What do you think of the likelihood that would be?"
Yeah, certainly if the Republicans control either the House or the Senate, it's not going to happen. The corporate tax rate increase, the idea is to increase it by 1/3, right? We're at a 21% corporate tax rate. We are about the same as the rest of the world right now. Remember, before Trump, we were at 35%. We were the highest in the world. Now we're down 21%. We're right in the middle of the pack. If we were to go down 15%, we'd be down among the lowest. And it would it's a bit of a race to the bottom, right? So it's encouraged other countries to lower their tax rate. If the Democrats control, I'd give it a toss-up. I'd say 50-50. But if the Democrats don't control, I would say there's no way that one gets enacted. Because again, that's not an expiring provision like the others are. The others expire either at the end of 2025 or in some cases the end of 2026. Most of it expires at the end of 2025. So we will see massive tax changes next year, one way or the other, no matter who's in office. So don't ignore that there are tax changes coming up. And I do think that there's a pretty decent likelihood, unless the Republicans sweep, there's a real decent likelihood we're going to see a decrease in the estate tax exclusion. So anybody who currently has or is expecting to have their net worth in excess of $7 million, I would do some estate planning right away. All right, who's next, Jamie?
let's see, we've got an anonymous question that says, so with Harris, if we sold an asset, then capital gain taxes will not be applied if less than 500K. Does this limit also apply to inheritance or passing assets to heirs? And if not, what's the limit?
So the capital gains tax increase. So capital gains taxes right now go from 0 to 20%, not counting the net investment income tax, which is 3.8%. Okay. Net investment income tax applies to income over 250,000. So the Harris proposal would increase the capital gains rate only if your income's over $500,000. And that would be, by the way, it's to the extent it's over. So the first 500,000 would be taxed at the current rates. So we're going to still have that 0 to 20% current rate. That's not exempt. Okay. Capital gains tax under the Harris proposal. That's the same rates they are now. It's just the increase, that 28% surtax. So now we'd have a third tax rate for a fourth tax rate for capital gains, right? We have a 0% rate, right up to almost 100,000 now of capital gains that are taxed at 0. Then we have a 15% tax rate. Then we have a 20% tax rate. And now we would have a 28% tax rate. But let me make a point here of one of the reasons I don't like this. It really has a negative impact on business owners. And I'm a huge fan of entrepreneurs. I think entrepreneurs are the lifeblood of our country. I think they're the lifeblood of any country. And an entrepreneur, not just a small business owner, an entrepreneur, somebody who's constantly building businesses. And the reason is because if you're an entrepreneur, what happens is you put your money back into your business. And right now, as long as you put your money back in your business, you're not going to pay tax, right, while you're running your business because it's going back to the business. Only amount you pay tax on is what you consume. It's very much a consumption tax if you're a business owner. So let's take a business owner versus somebody who puts an employee puts their money into a 401k. And let's say at the end of, let's say that they're ready to retire. Well, what does a business owner do when they retire? They sell their business. So historically, and by the way, you're going to pay the tax all in the year that you sell the business because buyers don't like to pay over time. They want to pay right now. Typically, most buyers are private equity. They want to be done with the transaction. So they're going to pay all the money now. So let's say that your business is worth $4 million versus a employee who's put money into their 401k. They both want to have $200,000 to live. And I actually did this in a weekly report. I actually have done this example before. So I would go back to our weekly report. If you're not a subscriber, please subscribe to our weekly report. You can do that at wealthability.com. And, but what happens is that the business owner ends up paying a premium because that $4 million capital gain, all going to be capital gain. They don't have any basis probably. So on the, let's say they're married. Okay. So they get $1 million, not 500,000. Okay. That first million is going to be taxed at normal capital gains rates, but from $1 million to $4 million or $3 million of it's going to have that extra 8%. Okay. Well, let's compare that to somebody with a 401k. Somebody with a 401k, you're going to be taxed as you take the money out. Well, because of our graduated tax rates, you're probably going to be in a lower tax rate than 28% as you take that 200,000 out. Your average tax rate, not your marginal tax rate, your average tax rate is going to be less than 28% under certainly either Harris or Trump. Okay, so you're going to end up paying less tax as an employee. So this is another one where it's better for the employees because they're going to emphasize the 401k, because if you put your money into a 401k versus a business, you're going to end up paying a higher tax on the business than you are on the 401k. So that's one of the consequences. And by the way, it's not 28%. Remember, it's 33% because not right now, again, another change is Harris wants to eliminate the exemption on capital for the net investment income tax for business owners. And if you, that are over that threshold. And what that means is that it's not a 28% rate, it's a 33% rate. So now you're paying 33% on pretty much that whole $3 million, you're gonna pay 33%. So you're gonna pay a third. So you're gonna pay $1 million in tax. You're gonna end up with less than $3 million. Whereas so it's very much an encouragement to be an employee. And this would be a worker. So, by the way, there was a comment I noticed that consumers are workers. That's true. There's no question about that. And I didn't mean to say that they're not workers, and I'm not meaning to say they're not important. And they pay a lot of tax. Okay, they do. They pay more tax, far more tax than the B and the I side of the quadrant, the big business owners and the investors. And that has been the way it's been for the last 60 years. Now, should it be that way? I'm not one to make an argument one way or the other. I'm just saying that's the way it is. And so I'm telling you what the changes are. All right. Let's take another question. Jamie.
All right. Leah asks, have either candidate advocated for eliminating the SALT cap or retaining it?
Yes. So the SALT cap, state and local tax deduction, is capped at $10,000. Now, eliminating the SALT cap is a little, it's not as big a deal. Actually, the SALT cap is not as big a deal as people make it out to be. And let me explain why. Because prior to 2018, we had an alternative minimum tax that applied. You had to add back your state and local tax deduction. So when that went away, there were a lot of people that their taxes did not go up. Even though they lost that deduction, they didn't really lose the deduction because they weren't getting it in the first place because of the alternative minimum tax. They changed the alternative minimum tax, so it's a much higher threshold now. It's only when you make huge capital gains, typically, that I see an alternative minimum tax, where I used to see almost every client in California, New York, New Jersey had paid alternative minimum tax because of the state and local tax deduction that was added back. So they lost that tax benefit. So it's not, this is a challenging when I see this in the press, because it didn't hurt people as much as people think it did. And now we have the pass-through entity tax deduction, which, by the way, Harris has proposed taking away that pass-through entity tax benefit. But we have the pass-through entity tax deduction, which largely offsets that, at least for business owners. Okay, it does for entrepreneurs. So being an entrepreneur, I kind of like that one. Trump has proposed eliminating the SALT cap. Now, there are a lot of Democrats who have proposed eliminating the SALT cap too. It has not passed. It's about $1 trillion over 10 years. So it's a pretty big number, but Trump has proposed specifically eliminating the SALT cap deduction.
All right. Our next question comes from Gary. I have rental properties in Panama. How would the proposals affect this because it is international?
Probably not. I don't think the proposals would affect you at all. You know, unless Trump's proposal on worldwide income means that you're not taxed on your Panama income when you live in the U.S. But that's not really what he's been talking about. He's been talking about U.S. citizens who live abroad. Okay, is really what his proposal has been discussing. So given that, I'm not sure that I've seen anything that would affect the tax on your income from Panama.
Nice. Our next question comes from Todd. Is cost segregation used in real estate still an effective tool for deduction over time, thus offsetting income?
Yeah, for sure. So cost segregation, by the way, is simply when you buy a rental property, you buy rental real estate, you're basically buying the land, the building, the land improvements, outside land improvements, and the contents of the building. A cost segregation just identifies what portion of the building goes to each of those 4 areas. With bonus depreciation, any of the land improvements and the contents have been 100% expensed or deducted in the year you bought it. Bonus depreciation is now down to 60%, and eventually the end of 2026 phases out entirely. Okay, so under Trump's proposals, it would come back. We'd get that. Cost segregation, though, we've been doing cost segregation long before the Trump Tax Act. So cost segregation, at a minimum, it accelerates. So instead of a 27.5-year property or a 39-year deduction, you get over 5 years or 7 years. That's much better. So it's much accelerated. So yes, cost segregations, I'm a huge fan of them. By the way, the tax law technically requires them. The IRS does not. But a cost segregation in most cases, even on smaller properties, makes a lot of sense.
All right, we have Mersha asks, the unrealized capital gains won't apply within 401ks, right? And outside of retirement accounts, it applies to people making over 400,000 annually, or is this net worth in investments? How will that affect traders? And then
Okay.
she also says, also the two economic plans, which will raise our personal taxes and which will reduce our personal taxes.
Okay. So on the second question, it depends on who you are, on which plan raises your personal taxes. If you have 6 children under the age of 18, Harris's will reduce your personal taxes by a lot. Okay, because you got all those tax credits, just like during COVID. So it really depends on who you are. If you're, if you make over $500,000, Harris's plan probably increases your taxes. Okay, if you make under 500,000, Harris's plan probably decreases your taxes. Trump's plan probably, from where you are today, probably might increase your costs because of tariffs, but there would be no direct tax increase. And there would be no tax increase pretty much on either side. But Trump also, of course, some of these proposals like overtime pay, et cetera, it depends on who you are. On the unrealized capital gains tax, that is only for people with a net worth over $100 million. That's the proposal. Only if your net worth is over $100 million. Would it apply to your their retirement plans? I don't see an exemption for that in the explanation. Now, the explanation is really brief. It's like 1 page. So would it apply to retirement plans? I suspect it would. I suspect it would. By the way, there's another proposal in there that if your retirement plan is over $10 million, then every year you have to distribute 50% of the excess and pay tax on it. It's treated as a required minimum distribution. If you don't, there's a 25% penalty. So that means that if your pension plan or 401k went from 10 million to 12 million, you'd have to distribute $1 million and pay tax on that $1 million. And then the next year, if it just stayed at 1.1, you'd have to distribute 500,000. Okay, so 50% of the excess. There's also, by the way, a proposal to eliminate backdoor Roths, which means converting a taxable retirement plan to a Roth plan. That would also go away for high income taxpayers. So those are, but again, I do want to minimize, because there's been a lot of upset in the ether about the unrealized capital gains tax. And remember, it only applies if under the proposal. Now, down the road, could it change? Yes. But under the proposal, it only applies if you're over $100 million of net worth. Let's take two more questions.
You got it. Our next question comes from Denise. Does Trump plan to extend the 2018 Tax Cut/Job Act?
Yeah, in totality. In totality, he said he wants to extend the entire 2017 Tax Cuts and Jobs Act in its entirety, which includes every aspect from qualified business income deduction to standard deductions, to with the exception of the SALT cap, which he says he would change. Right, how much he would change or whether he would change is really up to Congress, but he would extend it in its entirety. Harris, by the way, would extend it for people making under $400,000.
Great. We have a live question from Martin.
Martin.
Egan, just another thing, people focus just on the tax, and if you make over $100 million on the unrealized capital gain, but there's also the repercussions of the massive sales of assets if that is implemented, and what they could do to people who might only have $50,000 income, but their 401k gets wiped because Elon Musk has to liquidate half his Tesla shares. That's an extreme case, but I mean, there's assets like real estate. People have to start liquidating real estate assets as that drive prices down. There's a whole lot of unknown repercussions that can happen if you force a lot of wealthy people to suddenly sell assets.
So it's a good point. And as I mentioned previously, there would be an impact for sure on the stock market. People who are heavily invested in, but real estate, by the way, under the proposal, you would not have to liquidate your real estate. You could defer the tax until you sell it. So you could defer it. So you would not have fire sales of non-liquid assets under the proposal as it is in Biden's Green Book. Just so you know, that's something that I think is actually a very important distinction. I'm not justifying this. I'm not trying to say this is a good thing. I still don't like it. But under the proposal, just to be clear, you would not have massive. You would probably not have massive liquidations or fire sales required of non-liquid assets, meaning stuff other than the stock market. Stock market, it would definitely impact the average person because it would definitely have an impact on the stock market. Right. Okay. I'm going to pick one more question. A lot of interesting comments in the questions. Let's see if I can find any. Oh, there was a question on the change to retirement accounts that I just mentioned. I just answered that. I do have a question. In fact, maybe we can put this in the chat here. Jamie, do you have a list of CPAs? Yes, if you go to tfwadvisors.us, we have a franchise of CPA firms that can certainly help. There's a question on conservation easements. Those are the IRS and the tax courts going after those. Interesting question. Where's Harris on bonus depreciation? We have not heard where she is on bonus depreciation. Very interesting. Boy, these are really interesting questions. So here's let's see. Okay, I think, let's finish with this one. Thomas asks, well, either candidate can make bold promises to voters. Do you see either candidate being able to get any of their promises passed through Congress? Let me tell you the most likely things to get passed through Congress in general. Okay, and we'll finish on that note. I would say the child tax credits, the research and development expensing, and the 100% bonus depreciation, those are most likely. I think the tax rates that were cut under the Tax Cuts and Jobs Act, maybe with the exception of the highest rate, the 39.6%, the 37% might go back up to 39.6. But I think those rates are probably here to stay because both candidates want them. So those are probably the big ones, I think, that we're going to see. I think it's likely that the corporate tax rate does not change unless if Trump and the Republicans were to win, I think we would see that 15% tax rate for U.S. manufacturers. I do think that would probably happen. Other than that, you're absolutely right. Congress passes tax increases, not presidents. Presidents just sign the bill. Okay, so we've seen a lot of tax proposals over the years from presidents that never get done. So that is a very good point to make. Remember, it's Congress, so don't forget when you're voting, don't just vote for president. Make sure you're voting for your senator, your person in Congress, because they have a bigger impact, frankly. But remember, they're also Republican and Democrat proposals. So they're not just Harris and Trump. I think remember, a lot of these Harris proposals were Biden proposals. So they are Democratic proposals, and they were in the Build Back Better Act, a lot of them. A lot of the Trump proposals, they're Republican proposals. They were in the 2017 Act, the tariffs, by the way, that's one thing that they seem to both agree on. The only thing that Biden didn't change of Trump's policies was the tariffs on China. And of course, Trump's tariffs are 20% across the board, is what he said, and 60% on China, although he did recently talk about a 200% tariff on cars from Mexico. That's a challenging one, but that's what he said. So good point. These are proposals. However, I do want to point out that, I think where these two candidates are furthest apart is on their economic plans, and whichever one you like, make sure you consider that when you vote. If you're interested in Wealthability Live, please join us with our special offer. If you're interested in a tax advisor, please go to tfwadvisors.us. We're happy to help you there. But most of all, we're just happy to help any way we can. Thank you. And just remember, the better educated we get, the more information we have, the better choices we make, the better decisions we make, the more money we make, and the less taxes we pay. Thanks, everyone. We'll see you next time.